Is a correction looming? Hey everyone, I'm Maggie Lake, and today I'm talking markets with Vincent Deluard, the Director of Global Macro Strategy at StoneX. Hi Vincent, how are you?
I'm great. I'm great, Maggie. Good to see you.
Good to see you too. And you are fresh off some international travel in Brazil. Is that right? How was it?
It was lovely. It's winter there, so it's a little cold. I think it was like one of the coldest winter in Brazilian history. But even a cold Brazilian winter beats a San Francisco summer. So uh, I
This,
enjoyed the. I was the only one on the beach. My kids were the only ones swimming there. Uh, for us, it felt warm.
yeah, exactly. All the famous comments about San Francisco summers. I love it. But that's so great, and I love the sort of firsthand experience. We'll have to talk about that and what you saw. I know you're on holiday, you weren't working, but I know you've been keeping a really sort of international lens on things, which we're going to dig into because you've been doing some super interesting work. Just to note, hey everybody, joining us live on YouTube and on Substack. It's great to see you. Happy Monday. As always, put your questions in the chat, and we'll get to as many as we can. As you can see, I'm coming to you from a slightly, I'm MacGyvering this. Like for anyone who was with us last week, you know, we're having some tech problems. They continue. We just said technology's as tired as we are. So we're working it out. I'm not really sure what's going on. We have an idea, but more work needs to be done. So hopefully we'll make it through this one, but appreciate your patience. So we are sort of starting this week, it really kind of feels like in a holding pattern. You know, stocks drifted higher, yields in the dollar steady. It seems like investors are waiting on, maybe they're on the beach too, Vincent, but they're waiting on tariff news. We have some inflation readings coming up. We're going to be starting to hear earnings as well. Which do you think is most likely to be impactful? What are you looking for here?
I think the big one is the CPI tomorrow. Yeah. Because my view is that it's going to be a bad number. We got lucky in with the June number. Sorry, the main number that was reported in June. There was a positive seasonal adjustment. Core goods were not really affected because we had this pause on tariff. I think people wrongly jumped to the conclusion that, oh, tariffs are not inflationary. Well, of course, because there's no there's no tariffs. Used car prices went down, airfare went down. I mean, everything that could go right went right, and still was not. It's a very small beat. So my concern is that reverts in July. Everything that I mentioned basically is the other way. The base effect is going to be a negative. June of 2024 was flat, so we're not going to get a good base effect. The seasonal adjustment is going to be negative. This covers the how do you call that now? The 9-day war or whatever, the Iran. Anyway, but we had 13 straight days of gasoline prices going up. We had a weak dollar. We had the tariff payments. So the chunk between May 22 and last week, we got about $60 billion collected by U.S. Customs. So presumably that's going to be in prices for in June, and it was not in May. So yeah. The consensus is that it's going to reaccelerate. We should be looking at that 0.3 month over month, up from 0.1. I suspect it's going to be a bit harder than that. And then that will, we had a bit of a reckoning already on the cuts, for the market was completely out of its mind to price a July cut. That's kind of out. Odds for September are down to about 60, 65. I think it should be closer to 50. So I'd be really looking for that as a basically the market drawing the conclusion. So we had this imaginary recession, right? In Q1, everybody freaked out, and and the rebound was a realization that there's not gonna be a recession. And we took the positive stuff from this. Okay, earnings are gonna be okay, and that's why the market is over. There's also some negative aspect with the fact that the economy is really running hot, is that, well, maybe you won't get the rate cuts, and maybe yields need to come higher. So instead of having a too cold moment. We could have a too hot moment as a potential trigger for a correction. You mentioned earnings. I think earnings are going to be okay. Not much to see there. We still, companies guided a bit lower in Q1. There's still a little bit of this fear. So I think they'll clear it up. I mean, what I'd be looking more for is how they guide for the end of the year, because we still have this kind of back-ended EPS, but the actual number, I think we'll see, 75-80% beat rate. So I don't think the market's going to really sell off.
Yeah, it'd be interesting to see if we get a little bit of color on, some of the tariff concerns. But, by the way, the one thing I didn't mention, which was moving today, of course, is Bitcoin. It's over 120,000. And we'll talk about that in a second. But you've been thinking there was going to be a July correction. Are you still feeling that way? Because it doesn't seem like anything bothers these markets. I mean, Bitcoin over 120 as an indication, perhaps, of that risk on. They seem to be able to kind of brush aside any concern, really, that comes up. Do you think that we're still going to get a recession? And if so, what do you think's the catalyst? A correction.
Yeah, no recession. I'm the no recession guy. Okay.
That's right. You're the no landing, no recession guy. But what about a correction?
I had this call for a July correction, and I'm maintaining it. Of course, we'll see. I mean, it's if you make short-term verifiable forecasts, sometimes you look like a fool. I would rather still say something interesting and look like a fool than just do the thing that a lot of people do. Or I think this could be some volatility.
Yeah, hedge it to death. Yes, I agree. Exactly. I think we all agree.
Stocks, buy low, sell high. I mean, okay. Yeah. So anyway, yes, why did I think there would be a correction in July? On the fundamental side, 3 triggers. One was the return of Tariff Man, which we had, by the way, in drove. So the idea was, that April 9 was a pause, July 9 is the end of the 90 days. Now it's extending to August, and that turned out even stronger. I think. If you look at the rates in the letter, the thank you for your attention to this matter letter that Trump sent, they're very often higher than before. You even have Brazil at 50% just because he's not happy with the situation of Bolsonaro. Vietnam was way higher than what Vietnam was one of the ones we're supposed to have a deal with. And then even the Vietnamese is well, hold on, we're talking about 15%. We never agreed to that. EU is talking 30%. Now, maybe there is some bargaining and people are actually talking behind, but I have trouble believing that there is this kind of back channel of negotiation going with so many countries at the same time. I mean, so yeah, it's odd, but yeah, it's happening. I think the market is not believing it yet. It thinks so. Maybe it's more of an end of July story when we approach that August 2 deadline. It was oh shit, this is really happening.
Yeah. Remember we had that, and we have a lot of people away, so you have thinner markets, and we had all the issue with the yen carry at the beginning of August last year. So the idea that we can sort of drift peacefully into the summer. I mean, you may be off by a couple days, but I don't think it's not easy to sort of wave the all clear when you have some of this.
Let me go back to the idea was that, we had 3 triggers. So one was the return of Tariff Man, which again might be postponed, but I would not call it. I don't think we're out of the wood by any stretch. Number 2 is this realization that a strong economy also means higher rates. And we certainly got that, a non-farm payroll where they're very strong. Yep. All the labor market data has basically been confirming what I've been expecting. Now the 2 big days here are tomorrow's print, and if it's really bad, it could be the trigger. It could be the if we have a big bust on inflation, we could see the market down 3-4% tomorrow. The other deadline to watch here is the Fed July meeting. I think that this is going to be a very important Fed meeting because we have all this. We'll be looking for Powell's response to Trump, to all this kind of political activity, and my guess is that Powell is going to try it. I mean, at this point, he's already at war, right? So what's the point in appeasing Trump? I mean, he's going to get fired anyway. He might as well fight it off, and he would be right. I mean, again, the economy is running hot. The labor market is tightening. The deficit is huge. I guess we'll talk more about that in a little bit. So, you see all these kind of speculative stuff. Silver prices up by 7-8% last week. All the crypto meme stocks soaring. So this is not the time when you want to be, cutting by 100 basis points. So July 30, yeah, maybe it pushes everything out to end of July, early August. So yeah, Fed meeting plus CPI was my second trigger, and then the third trigger, which was the refilling of the TGA. So one thing that helped equity markets this year, and bond market especially, is that we could not issue new debt because of the debt ceiling. Sorry, the government had to draw down its general account at the Fed. When it does that, it's functionally QE. You take an asset from the Fed and you give it to people. But of course, you can do it until you hit zero. Now we're not at zero yet. We're at about 300 billion on the TGA. As part of the one big beautiful bill, we lifted the debt ceiling by 5 trillion. So over the next 4 weeks, we should see about let's call it $500-600 billion of Treasury issuance. We can get some of that out of the reverse repo facility, especially if we do bills, because it's kind of short duration to short duration, but there will be a drain on bank reserves. And that will be the first time since COVID really that the excess liquidity has been mopped out, and now the Treasury is kind of competing with other actors for funding. And again, this has not happened yet. So we lifted the debt ceiling, but we haven't issued the debt. The TGA is, as of July 9, it was at a 2-year low. So that's going to happen in the next couple weeks. So again, I'm not giving up on my call. Now, if none of these things happen, I'll wave my hand.
Revise, right?
I was wrong, but let's at least give it to, let's say, mid-August. It could be that it doesn't happen. It could be that, we have these great earnings. In general, when the economy goes well, you don't have very steep correction. It's a very hard position, the one that I'm in, where you're bullish on the economy and bearish on the stock market, because it's usually at the end of the day, if EPS are fine, stock market keeps going. So I knew it's always difficult to make a correct, like, because it's not like a recession. It's not like there's true economic deterioration, right? It's positioning, it's sentiment, and it's liquidity. So it's much harder to predict.
Well, it's very interesting. Somebody commented it's kind of like there's no stopping the train. And it seemed we saw retail just step in aggressively, right, in April, and it really worked for them. So does it feel like is that what do you worry about that with market sentiment feeling overextended, that we just keep, it keeps kind of reinforcing itself, and you've got people who are perhaps out over their skis, when it comes sentiment wise?
No, and I kind of like that, right? Because you want this kind of one-sided speculative inflow as a sign of a top, right? And we are getting them. So to me, it's we're getting closer. And could it keep going? Could it kind of feed on itself? It seems. I think you're right that the first to buy was the retail. Then you get your momentum, vol targets, CTF funds that reinforce the mechanism, right? So a volatility target fund, as volatility drops, it buys more, and then it buys more. That makes, so there's a little bit of, I think this is mostly over now. I mean, the VIX is at about 16. So I think these guys are in by this point. Where else could more money come from? I think there are two areas that haven't been buying, but I don't think they will. One is foreign investors. Well, to be fair, I think what foreign investors have been doing is they hedge the dollar. I think the trade for foreign investors is like they see all the signs in the U.S. as, okay, this is bad. Like, we have this fiscal crisis, we have this attack on the central bank, we have this very aggressive mercurial, like, but they want to sell, but at the same time, it's like the U2 song, with or without you. You cannot live with for the Max 7. It's like, I cannot live with or without the US. Like, you want to sell the US because you see all that stuff, but you cannot sell the Max 7. Like where else are you going to
Well,
find?
and if you didn't get back and you underperformed, right? You're chasing
It,
performance if you didn't catch that bottom in April when retail at least were the first in. So that's an issue.
so I think, sorry, just to finish that thought, I think
Yep.
what foreign investors are doing is that they're selling they're hedging the currency, but they're keeping the stock exposure. And I think that's, if you look at a chart of like Max 7 divided by the dollar index, it's just like straight up. So for now, like, I think the Trump shock has really hurt the dollar, but still people kind of cling to the stock market. Because as you mentioned, it's been so good, and every time you sold them, people lost their job, right? So
yeah, that's the thing, is even if you're in your gut. So I want to get to a couple questions. Thomas asking, the 10-year is up to 4.43. Where does it go from here? Do you expect to see, since it sounds like you think inflation is potentially going to be a problem with tariffs, do you think that yields goes higher on the 10-year?
Yeah, that was my scenario. And again, we're there. Just the stock market. My idea is like every time you get the 30 at 5, the 10-year at 4.5, you get some volatility in stock market, right? And all the correction, basically get a 5 to 10% correction every time that happens. So, I mean, the 30-year is already there. The 10-year is a couple days, bad auction, bad CPI, it could get there tomorrow. So yeah, I mean, my view is that yields need to go higher for a bunch of reasons. Secular inflation, deficits. I mean, let me just, if I may, give some stats on the deficit, on the
Yeah, go ahead.
It's because I'm really kind of a fiscal dominance guy, and I track that every day. So today I updated my spreadsheet coming back from vacation, and I had to check the number. Like I was like, is that an Excel error? It's so bad. It's not an Excel error. So as of Friday, the federal government had spent 4.5 trillion, 600 billion more than the same period last year. 600 billion more. Okay, keep in mind that we had those on paper should have done something. We had the tariff revenues. We have a great economy. We have a low. I mean, this is insane. The deficit is bigger by 300 billion bigger now than it was at the same time last year. This is insane. Spending is 63% higher than it was in 2019. 63% higher. I mean, we added $2 trillion in government spending since COVID. So I think that may be one of the reasons why stocks are performing well, is this kind of story that the deficit of the public sector is the profit of the private sector. Like this, such a stimulus from this. But it also means that yields should be much higher, much higher.
It's really interesting, and I want to get to one of your other pieces that you wrote, which is fascinating. So I'm just going to drop this and encourage everyone to go listen to it. I did talk to Daniel Lacaille last week. That released over the weekend. Many of you might have been on the beach. Go and listen to it. So he makes an argument that if rates were free floating in the U.S., which he thinks they should be, he's very critical of the Fed, that they'd be lower, not higher. And he doesn't see inflation anywhere, which is so fascinating. And I think this is why people get turned around, because there's sort of like two different worldviews, and there's a lot that goes into that. But it's really, really interesting, and it matters because this will play out, and you want to kind of be on the right side of it. So dig into that interview, everyone, and you can drop your comments, and we'll continue to sort of tease that apart about why we have those different views. David Kelly, Vincent, what do you think tariffs will do to corporate profits in the second half? David on Substack. Thanks.
My idea is that the first effect will be to pass it to consumers. So not much. It will just be corporations are intermediary, tariffs are a tax on the consumer, and tariffs just collect that tax and remit it to the government. Why do I believe that? Two reasons. One is three reasons. One is the precedent of 2020, COVID, great inflation. Companies just passed it on, no problem. Even companies who were not affected passed it on. There's almost like enabling effect, like, oh, everybody's raising by whatever 10%, I'm going to do mine too, get some margin there. We saw that during COVID. And I think at the end of the day, it comes from the lack of competition in most US markets. We do not live in a free market economy. Like everything, we have big tech, big ag, big oil, big tobacco, big pharma, big food. Everything we buy, if it's only like 2 or 3 companies. You go for a supermarket, how many makers of cereals are there, or dog food, or personal product? So there has been tremendous consolidation of US industry over the years, which gives pricing power. At the same time, again, probably not Danielle's view, but my view is that the consumer is actually doing fine. Like we have incomes are rising very rapidly, in large part because of the fiscal stimulus, because of the rise of the economy. So I think the consumers will be able to take it. Now, over time,
the wealthy consumers.
Pardon me?
Wealthy
yeah, but
consumers.
yes, but unfortunately, the U.S. is so unequal now that the poor don't matter, right? I mean, it's like the bottom. I agree. There is, probably bottom 10% of the U.S. population is really struggling. They're getting hit with the credit card, the delinquencies, the higher, but they don't matter anymore, right? So, the consumers are doing okay. Stock market is an all-time high. Bitcoin is at 120. Unemployment rate is an all-time low. Wages are rising by 5%. They're actually rising faster for white-collar worker now. We kind of flipped over since COVID. So, I think for now the impact is just going to be margins will not be impacted, but prices will.
Yeah. Gosh, when you describe that, you just think, what could possibly go wrong? It feels like, dancing on the Titanic. But so talk to me a little bit about you put out a really great paper. All of your research is so good, but you put out a really one that caught my eye. I messaged you about it. And you're talking about the reverse Asian currency crisis, the potential for this. Talk to me a little bit about what this entails, because that headline really caught my attention.
Yeah, no, it struck me. Part of it was just the calendar. It was the exact anniversary of the early July of 1998 when.
We should probably really briefly, for those there might be some listening who don't remember what this was, but nobody even knew what the Thai currency was until this moment. But we had the rapid devaluation of the Thai baht, and
then it followed like
cascaded, right? It caused a huge financial crisis, took down long-term capital, like the huge funds, and it it's the first time we got a peek at the fact that we had no idea what counterparty risk was hidden in this like interconnected global financial system. So it rolled on. It wasn't like a one-day event. It was a very, very big deal. The Fed had to step in and rescue and sort of bail out stuff and make deals and all of that. So anyway, okay, so it was the anniversary of that.
Yeah, and I think it matters because it's a generation pretty much, right? We're talking 27 years, right? So I think most of the people, this has left deep scar in Asia. Well, there are, I think, 2 events. So my general view is that Asian currencies have been suppressed for 2 decades. Partly also was the experience of the yen in 89 when after the Plaza Accord, right, the Japanese agree to revalue the yen, and it goes crazy, and then Japan ends up with 3 lost decades out of it, and then 10 years later you get these Asian crisis, and the lesson that Asian policymakers drew from these 2 events was that you need to have a cheap currency, because if you let your currency rise, then for Japan, it's the convergence. In the 80s, it looked like Japanese GDP was going to overtake the US, and convergence stopped. It's like a case of economic development stop on it, and that's a nightmare, right, for the Chinese. Is like that. They'll grow old before they get rich, and in their view, that's what happened to. Well, Japan got rich, but that the Japan catch-up story was stopped by the strong yen, and then for the other Southeast Asian nation, the terror is. There's a great picture I like. You see Michel Consu, the head of the IMF, And then he's looking down, and you see Suharto, the Indonesian president, and Suharto was like a general. I mean, came to power anyway. Like he was not he was a strong man, like and he had to resign. It's like, and it was very humiliating, like the maximal loss of faith. Loss of faith. He had to resign in order for the IMF to disburse the money to save Indonesia. So every Southeast Asian leader then takes the conclusion, I'm going to build my own IMF. I don't want Monsieur Condessu to come and tell me how to run my country and then to force me to be exiled in disgrace, as what happened to Suharto. So these led to this kind of 25 years of suppression of Asian currencies, and correlate to that, accumulation of claims and currency reserves. And I think we are at the end of that cycle, partly also the generational turn, like the fact that we need to explain what happened in most people now have forgotten about this. And it's like, yeah, why? I mean, it's why is there this fear of strong currencies in Asia? It's receding. The populations are aging. A lot of that also had to do with demography, right? I mean, in the early 90s, Asia was not a middle-aged continent, right? You had this huge bulge of people in the 20s, 30s that needed jobs. And the best way to get these jobs is to grow the manufacturing sector, export your way out of it, which is what they did with great success. Well, now, those who were, 30 in the 90s are 60, and now they don't need a cheap currency. They actually need a strong currency because they are retiring. So everything is kind of turning around. The need for dollar reserves is much less. If anything, they are trying to get rid of these dollar reserves. And everything that led to the Asian crisis seems to be reversed. Like the immediate cause of the Asian crisis was kind of this arbitrage opportunity where you had the Thai baht, so all the Southeast Asian currencies were pegged to the dollar, and then rates were higher in Thailand, Indonesia, so you could kind of make a risk-free. Of course, not risk-free. As long as the peg held, it was risk-free. You borrowed in dollar, you invested in the Thai economy, and then at the end you got more than if you had in dollars, right? So you made a risk-free profit. This is exact opposite. If you look at what happened to Taiwanese life insurers, it's exact opposite. So Taiwan dollar is pegged to the US dollar. Rates are higher in the US than in Taiwan, and then you have all these insurers who are doing the same thing, except they're borrowing in Taiwan and they're investing in the US Treasury market and pocketing a risk-free profit. So it's the exact opposite. And for the same reason that it, once it unwinds, it's self-reinforcing. So it's self-reinforcing on the downside in 1998, like the Thai, then the Indonesian, then the Korean. Now it's the up. So to me, in the metaphor, Taiwan is today what Thailand was in 1998. It's the canary in the coal mine. And you see the Taiwanese dollar up by 25% for the year, and then that's spreading. You see Korean won appreciating.
So what happens, Vincent, if you have a wave of these Asian currencies increasing in value, maybe fairly rapidly? Like, what's the investment outcome?
Well, first of all, I think it's quite good. It's quite good for the world. This was a major market malfunction, if you will. It was you're revealing true prices, right? For 25 years, we had fake prices, and as you move to true prices, I think the world is better off. We need to rebalance the world, right? I mean, the US has been consuming too much, and Asians have been suppressing. So overall, the world is closer to where it should be. There is this concern that it's going to be bad for Asian growth because they're export-oriented nation, and that has been the general reason why Asian currencies remain cheap, is that they're all trying to defend their market share, right? So if the Vietnamese dong goes up, you see intervention. The Korean won goes up, you see intervention. I think it's not going to happen this time because they're all rising together. So the problem in Asia is not having a a strong currency is having a stronger currency than your neighbor. Like if you are South Korea and the won goes up by 20% and the yen is down, well, activity shifts to Japan. But if they both rise at the same time, well, it just means that
Could you
the
an accord that coordinates that allows them to rise?
It would be informal, but I mean, I'm shocked by the similarities between Asia today and Europe in the 70s, where we had the exact same pattern, right? In the 50s, 60s, Europe was completely dollarized, depending on U.S. capital, and then they rebuild their economies, and then they get to this point where we had all these claims on the U.S. economy, which the French tried to redeem, get their gold out of Fort Knox, because like, oh, I mean, come on, like, I mean, I need feeling nervous about it, and then the U.S. kind of defaulting on these claims, which is pretty much what the U.S. is trying to do, and eventually the French, the German, the Italians figuring it out, saying, listen, maybe we don't need to go for the dollar when we do so much of our trade together. Let's, you know, the dollar was nice because it's an anchor, right? It's everybody anchors to the dollar, so it solved that coordination problem. You don't have to coordinate; you just, you know, outsource it. But you know, it's like, well, maybe we can coordinate, and because indeed, for economies that trade a lot together, you can't have too much volatility. So having a common anchor solves that problem. But there's another way to solve it is, like you mentioned, by an accord, which is what the Europeans did in the 70s. We had the snake in the tunnel, then the European monetary system, and you could see that, you know, developing in Asia. If you look at the volatility of Asian currencies, the volatility between the won and the yuan, the won and the yen, the Thai baht and the Indonesian rupiah, it's falling. So maybe it's just because the economies are more tightly integrated, so they react in the same way, or it is that, I mean, in some ways the central banks are managing it, right? They all have a kind of a basket. They try to manage the currency against a basket of the trade
right
partners.
From a more regional point of view. Right. So is this negative U.S. assets, positive Asian assets, or equities, or do you have to be careful about the way you express this shift?
I think broadly speaking, you're right. It's inflationary for the West, for the U.S., because we've benefited from that, right? That's the great moderation, the falling inflation, high growth era,
because 90s, they have pricing power. They would have pricing power.
Right. What was basically the East Asian, in Asia, it's the East Asian rapid industrialization, exports at a low currency, contain inflation here. So now we're going to have to pay a fair market price for it, and on top of that, we're putting tariffs. So and it's not like, especially if it happens to the continent wise, you know, like already with China, you have so many industries where China has 100% market share, more or less, right? The rare earth, the solar panel, but like if you add in, you know, South Korea, Japan, Thailand, Indonesia, like you have like, you know, probably 80% of the world manufacturing capacities there. So it's not like you're going to shift, like there's no alternative. So you're just going to have to eat that higher price. So yeah, it would be inflationary for the US. There's the asset channel as well. Asians are typically have recycled their surplus in dollar and in dollar assets. So if they let the currency rise and they rebalance total consumption, you could see this flow, these massive surpluses, trade surpluses that end up in U.S. capital markets kind of dry up, and eventually some of them selling. So yes, I would think it's basically we bought stuff from Asia by selling them treasuries and Mag 7 stock. So if that rebalances, the flow of capital is going to be weaker.
You describe this as something that can be a sort of healthy and necessary rebalancing. So you do not see it causing some kind of crisis or contagion in the way that Thai baht did, or does it just depend on the speed of the change of the reversal?
Yeah, I mean, it's not perfectly symmetrical, right? Because you can always prevent your currency from rising if it rises too fast. You just have to print some and buy someone else's currency, and on the contrary, your currency falls and you're out of reserves. I mean, it's nothing you can do, right?
Mm,
You need, in order to make the currency rise, you would have to sell reserves or gold that typically you don't have to buy your own currency. So it's not symmetrical. It's not going to be like, I mean, remember that the Indonesian rupiah lost like close to 90% of its value in a matter of weeks. So I think it's going to be more like a slowly rising tide. And yeah, at times, I suspect central banks will intervene to, if it gets too destructive. But we've seen already a greater tolerance. I mean, it would have been unimaginable a couple of years ago that, Taiwan would kind of accept, 20% appreciation of its currency in a matter of months.
mm,
So I think that also that impulse to kind of control the currency is a lot less pronounced, and also because that's what Trump wants, right? I mean, a lot of these countries were labeled as currency manipulator. I think Vietnam was, Thailand also. So that's a way to kind of appease Trump on the trade side. It's like, well,
yeah.
I'll let my currency rise, and hopefully we can get a deal.
Yeah, it's interesting because it's always just, watch what you wish for, because it depends on how it happens. But there's a positive scenario, and then there's something that's more disruptive. We'll end with this last question from Jordan. So over the next 3 to 6 months, does Vincent think the dollar is higher or lower from here?
That is a very good one. So in general, I'm a weak dollar guy. I think that great rotation movement is real. And if he asked me over the next 2 years, down for sure. The reason I'm hesitating is, 3 to 6 months. My outlook is we get a market correction, we get a hawkish Fed, we get a hot inflation number, hot job numbers. So in the short term, I could see the dollar rally through this correction.
Mm,
But yeah, and again, the move has been so rapid, right? This year, it just straight down that it would make sense to get a counter move, but it would be kind of a cyclical within a secular pattern of dollar weakness, because everything we see points to this lower dollar. I mean, we really have the pressures on the Fed, the foreigners pulling out,
mm,
the tariff, the out of control government spending. And again, it's good for the world. The dollar has been too strong for too long. A weak dollar will help global growth. It will force the adjustment that the big problem, it seems, is that we we all know Americans need to consume less and Asians need to consume more, but somehow policymakers are never able to actually take the actions that will be required. Right? In the US, I mean, at the end of the day, you have to shrink the deficit. That's it. That solves the problem. Like, it's not about tariffs or building $1 billion plant here or there. It's the deficit, but we cannot cut the deficit because we can't cut entitlement. And then in Asia, it seems like China always talks about stimulating consumption, but never actually does it, and it always ends up being subsidizing manufacturing. Well, if politicians can't do it, the market will do it for them. And a
mm.
falling dollar and a rising Asian currency does exactly that, right? It penalizes consumption in the US, and it reorients the Asian economies away from export towards consumption. So it is, nature is healing.
Yeah, that's a great way to put it. And if you believe that truth, then you're going to look for sectors that benefit from that larger trend that you're talking about, which is why we spend a lot of time. And I know you write a lot about and having an international lens on portfolio construction for this next section. By the way, all of you, I think it disappeared, but most of you were bearish the dollar. So you agree with in the poll that was in the chat. You agree with Vincent. Vincent, thank you so much. I know you're fresh off vacay, so we so appreciate you us being your first stop.
It's a
Fantastic stuff.
pleasure. I hope to speak again soon. Take care, Maggie.
Re-entry is hard. By the way, a little bird told me it's Bastille Day. Is there any kind of San Francisco celebration going on?
It is Bastille Day. So I've received a bunch of. I mean, but it's my first day back at work. It's very un-French of me to.
I know. You at
Work
least have
on
to have a
Bastille
glass of
Day.
wine or something.
My revolutionary ancestors would be ashamed of me. But yeah, it's a good time to remember that political change can happen fast and in very brutal ways, and things that we thought would last forever that lasts for thousands of years can, in 3 years after that day, the world had moved on in a completely different direction. So, yeah, maybe there is a lesson here for our U.S. audience.
Yes, maybe. A bit of a frightening one, but maybe. Vincent, thank you so much. Appreciate all the great questions in chat, everybody. We will see you again on Wednesday. Good luck. Take care.